Okay, so now we're going to talk about the scope and recognition and several other elements in relation to accounting for share-based payments. So what is share-based payment transaction and arrangement? So as I was saying that it's an agreement between the entities. So there are two parties, right, between the entity and another party, right, that entitles the other party. And now here the another party could be your employee or non-employee. Okay, so essentially what's happening is that that's an arrangement. A stock option or a share-based payment is an arrangement between the entity and another entity, which is employee or non-employee, that entitles the other party to receive cash or other assets of the entity for amounts that are based on the price of equity instrument of the entity or another group entity. Okay, so you are entitled for cash or other assets, right? Or you are entitled for the equity instrument. So in a way, when you look at an equity share-based payment arrangements, they are of two types, right? They are share settled, as we call it, right? Or they are cash settled. Okay, share settled or cash settled. That means what? You will either give cash or other assets. Very rarely you will give anything other than the cash, right? Or you will issue the equity shares. So both types of arrangement is what we see between the entity and the other party, which is an employer or a non-employee. Now, it's a transaction in which the entity, now what is it I'm receiving in exchange? I'm receiving the goods or services, right? So if let's say it's a transaction with a supplier, right, in which I agree to issue or do a share-based payment arrangement. So I may receive some equipment, I may receive anything, right, raw material or whatever, depending upon the terms of the arrangement. Or if it is with an employee, then essentially I'm receiving the services, right? Or it could be a third-party service provider also. Many times, commonly we also see a lot of these companies which give advertisement, right, in newspapers, and they don't have money to pay to these media houses, right? And what happens, they normally enter into an arrangement with these media houses that they will issue their shares to these media companies in exchange for advertisement of their services. So both parties in a way enters into this transaction in which I will do the advertisement for you, and you in exchange, since you don't have money, which is fine with me, I will take stock in your company, and if the company does well, I will in a way make money, by way of appreciation of shares. So that's another kind of arrangement, is what we see. Incurs an obligation, right, to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services. So it's also a possibility that entity incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services, right? So it is also possible that that you have entered this arrangement for the benefit of the employees of your subsidiary, or with the non-employees which are benefiting your subsidiary, so on and so forth. So if you have a holding subsidiary structure, you may receive the stock option of the subsidiary itself if you're an employee of a subsidiary, for example, or the holding may give it to the employees of subsidiary, so on. All kinds of possibilities exist here, right? So essentially what we're trying to say, it's a transaction, right, between the employer and the employee, or employer or the non-employee. Could be of cash settled or equity settled, and in exchange you receive either the goods or services, right? And what do you need to give? You either give cash or you issue your stock, right? So that's the transaction, is what is covered through this standard. Let's look at few examples of share-based payment arrangements between employer and the employees, right? So there could be a share appreciation right, SARS, that entitle employees to cash payment calculated by reference to increase. The key is for you to say that it is linked, it is a share based payment arrangement, the payment has to be linked to the movement in the share price of the company, right? Or I as an employee, I should benefit if there is an increase in the share price, or I may lose out if there is a decrease in the share price, right? Similarly, from a company perspective, there has to be, benefit from an increase or a decrease in share price of the company, right? The share appreciation right. So if, let's say, as a company, I give a share appreciation right. So I'm not going to issue the shares in a share appreciation right. What normally happens, you fix a exercise price, and then on the vesting date, you calculate the difference between the two, the market price of the stock, and whatever the delta is, what you end up paying to the employees, right? Employees to cash payment calculated. So let's say a very simple example is, I'm on 1st of January, and then there is this 31st of December, right? Let's say you are on this date, the share price was 100. On this date, the share price has gone up to 200. And let's say I've given 100 shares, 100 SARs, okay, to one employee. So what essentially we are doing here is that there is an increase in the price by 100. So at the end of the 1 year period, the company will make a payment of 10,000 rupees to the employees against this SARs. Okay, provided you have in a way fulfilled the vesting conditions from that perspective. Now, there could be share ownership plans where employees receive an entity shares, right, in exchange for their services. So you will be issued the shares itself as opposed to receiving cash. This is called a share-based payment, share settled payment arrangement. Either you have a cash settled or a stock settled in a way payment arrangement. Now, there could be a share-based payment arrangements that are not between the employer and the employee. That's also a possibility, that there are arrangements that are not between the employer and the employees. So, an external consultant may provide services in return for shares in the entity, right? Not an employee, an external consultant, right? Let's say I want to provide services to a company, or you as a company want my services, you don't have money, or even if you have money, you want to say, I want to settle this by way of issuance of stock, right? That's also a possibility. A supplier may provide goods in return for shares in the entity. All kind of things we see, right? Because end of the day, you have to look at it that shares are nothing but a currency, right? Shares are another form of currency, because you derive value from the shares, right? Which represents the underlying value of the company you are dealing with. So it's like a form of exchange, right? Like currency. A shareholder may grant shares to an employee, right? That's so. What does this mean? It means that there's this holding company, and or there's a subsidiary company, right? So essentially, what's happening that if you are an employer of S, right? You are an employee here of S. So instead of receiving the shares of S, you given the shares of H. So H is the shareholder, right? The shareholder is giving his own stock to the employee of the subsidiary. That's the one possibility. The other possibility, let's say there's an individual shareholder, Mr. A. Okay, sometimes we see, not many times, I would say, sometimes we see that Mr. A may also give his own from his holding, if he wants to, let's say, prevent the dilution or anything like that. Mr. A gives, in a way, the stocks to the employee, in a way, from that perspective. All of that are in a way needs to be accounted for under Ind AS 102. All right. So what all, in a way, it encompasses equity settled share-based payment arrangements, right? As I said, that what is an equity settled share-based payment arrangement? Where you're going to settle the transaction between the employer and the employee, or the employer and the non-employee, by way of issuance of shares, right? By way of issuance of shares. Okay. Cash settled share-based payment transaction, in which you're going to settle the transaction between the employer and the employee, or the employer and the non-employee, by way of by way of actually giving cash or other assets of the company, right? Either by giving cash or by other assets. Now, how much cash to give, the value of that cash is or the amount of the cash, that is determined with reference to the stock price movement, right, between the terms of the arrangement between the employer, or terms of that share based payment arrangement. Okay, so the amount of cash or other assets to be given is to be linked to the stock price. Then only it's a share based payment arrangement. So you may settle it by way of issuance of shares itself, or by giving cash, or there could also be that there is an optionality, right? You may settle it by issuing stock or by giving cash, right? And that at times can be is a choice which is with the entity, which is the issuing company, or sometimes it can also be choice with the employee, to say that, so both parties, right, the employer and the employee, if I were to, for simplicity, so there are, in a way, there are three possible parties, right? Employer, employee, or a non-employee. Okay, so when you look at this share-based payment transaction with cash alternative, now this alternative can be in control of the employer, that I may give you share or I may give you cash, or this may be in the control of the employee many times, depending upon the type of the arrangement, that I may decide to demand the issuance of shares, or I might decide to only request for the payment in cash, the difference between the exercise price and the market price on the date of exercise. And we will talk about all of this, what's the vesting thing, what's the grant date, what's the exercise price, and all of that. Or it can also be an option with the non-employee. So it's not that all of these are contractual in nature. Try and remember this is contractual in nature, right? It is not that you have a free choice here. The choice is not free. The choice has to come from the contract, is what you have signed with the employer, or what the employer has signed with the employee, or with the non-employee. All of the possibilities exist. It is in between the employer and the employee to decide, right, how do they want to enter into this arrangement. So it could be a share based settled payment, share settled, or equity settled share based arrangement, or a cash settled share based payment arrangement, or a share based payment transaction with cash alternatives, right? These are the three possibilities which exist in relation to Ind AS 102. So let's just take an example. An entity purchases some inventory from a supplier, right, for which the entity will issue 100 shares as consideration. This is equity settled, because I'm issuing 100 shares, right? I'm not giving any option here to give cash, right? I'm just going to issue 100 shares. So that's an equity settled share based payment arrangement with a non-employee. It's a non-employee. Okay, now an entity purchases a machine from a vendor or from a supplier, for which the entity will pay cash equivalent to fair value of 100 shares in 3 months time as consideration. Again, this is a cash settle, right? Because here I'm paying cash, right? I'm going to pay cash. Here I'm going to issue shares, right? So that's the difference. Now this is equity settled, and this is cash settled. Okay, this is equity settled and this is cash settled. Now an entity purchases an asset from a supplier, for which the entity will issue 100 shares in 3 months time, or pay cash, right? Now that's a alternative arrangement, right? I may give you share, or I may pay cash, right? That's a choice. Choice is in whose control. Now that's very important for you to again get the accounting right. So you need to understand, is the choice to settle is in the hand of the issuer, or the choice to settle is in the hand of the recipient, okay, which is the employer is the issuer, right, or the grantor, so to say, and the employee or the non-employee, as the case may be, is the recipient, okay, or the other side of the party or the side of the coin. So we need to evaluate in whose control the settlement is. The optionality is in whose control, and that is will drive the accounting. And we will talk about this, right, with the help of an example as well. But all three, equity settled, cash settled, or settlement of equity settled with a alternative for cash settled. These are all three different types of possibilities which exist, right? Okay. Now let's talk about employee as the service provider, right? Which is the key, which is what commonly is what we see. Employee of a company working as a service provider to an entity and receiving share-based payments, right? Stock option, warrants, etc. What is scoped in? A Limited has granted 100 shares. Okay, A Limited has granted 100 shares to its employees who completes 3 years of service with the company. Right, 100 shares, which is what I was telling you. That this is an mechanism to incentivize employees to be in my employment. Now he's locked in for 3 years. So if he were to leave before 3 years, then he won't get any shares, right? And that's where it also works as a effective retention strategy, right? A retention tool from an employer and the employee perspective. A Limited has announced a bonus plan for its employees where the amount to be paid is based on share price of A Limited, right? That's another arrangement, which is what is out there. Now, example of what is not covered by the standard, right? As it is as not based on the share price. So if it is not linked to share price, it's not covered, right? So you've announced an incentive scheme in which it has granted INR 5,000 to each of its employee, which is based on the current equity. So what is the whatever the, let's say I say I want to pay to all my employees 5,000 rupees. Let's say my stock price is 500 rupees. So 10 shares equivalent to each of my employees. Now this is not in scope because there is no equity risk which I am taking as an employer or you taking as an employee. So if there is no equity price risk, then in the arrangement, then it is not a share-based payment arrangement. Then it is a another incentive plan or a bonus arrangement or so on and so forth, because it's the price has been fixed today, right? And the amount which is to be paid is already been fixed. It is no longer variable, right? The benefit has to be linked to the share price for me to say that it's a share based payment arrangement. Otherwise vanilla like salary, I can say today the price of the gold is 50,000, so I'll pay you price of 10 grams of gold. So it doesn't matter, right? If I'm going to say that I'm going to pay you 50,000, then that's the 50,000, right, which you're entitled for. So not in scope of Ind AS, as the amount of incentive, though based on equity price, is fixed at the grant date. It is fixed at the grant date and will be paid even if the share price increases or decreases from the current level. So it doesn't matter, right? It doesn't matter. All right. What is scoped out, right? What is scoped out? If this is a transaction with the shareholder, right? So again, we're talking about shares. So are we transacting? Are we getting these shares in the capacity as an employer-employee relationship, or an employer-non-employee relationship, or in the capacity as an investor? Right, in the capacity as a shareholder? Is it a shareholder and investor transaction? If the answer to that is yes, then it is not covered under Ind AS 102. Then you have to deal with this appropriately under another accounting standard, right? So you shall not apply to the standard transaction in which the entity acquires goods as part of, again, if you're doing this as part of a business combination, right? If there's a business combination involved, then you apply Ind AS 103, and we will talk about Ind AS 103 at great degree of detail, so that you have full appreciation of Ind AS 103 as well, right? So but if it is something which is being issued as a result of a business combination, then again you will account for that under Ind AS 103 and not account for that under Ind AS 102, right? If there are financial instrument issued to buy or sell non-financial item which can be settled at net, will be outside again Ind AS 102. In a way, they in a way take the color of derivatives, right? So you will then account, those stock options are also derivatives, right? But they've been scoped out from financial instrument standard, because you then account for them specifically under Ind AS 102. All right. Okay. Let's take this example, right? Now we're going to deal with this example. XYZ Limited is acquiring a business from Mr. A. It was an individual. XYZ Limited issues equity shares to Mr. A. Now, Mr. A will continue as an employee with the merged entity. In this case, if the equity instrument are issued in a business combination in exchange for control of the equity, then it is not within the scope of the standard. Okay. So if it is related to business combination, as I just said, right? If it is related to the business combination, then it is not within the scope of the standard. However, equity instrument granted to Mr. A in its capacity of employee, assuming that these benefits of equity shares will accrue to you if you, in return for future continued service, right? And if you were to continue to be in my employment, then only you are entitled for these shares. Then that is covered under Ind AS 102. This is then covered under Ind AS 102. So you got to be very, very careful, right? In many business combination arrangements we see, where let's say you acquire a company, and along with the company, the founder of that company also comes along. And the founder who comes along, he says that, I also want to participate in the wealth creation, right? Future wealth creation. And hence you say, okay, I'll give you share-based payment arrangements. We'll enter into a share-based payment arrangement. So if the value of the combined company goes up, you will also benefit, right? Now, if that share-based payment arrangement is linked to the continuous employment by the selling shareholder, then that is covered under Ind AS 102 as an employee compensation arrangement, right? However, if the benefit to be derived by the selling shareholder is not linked to the continuous employment, but they are linked to another factors, let's say meeting some EBITDA target or meeting some revenue targets, right? Then they are then in a way, so they're not linked to my continuity of employment. So I will be paid if the business meets those targets. So whether I am in your employment or not doesn't matter. If somebody else will come in, somebody else will do a great job and those targets will be met. If the answer to that is yes, then they are a business, they are covered under business combination, like a contingent consideration. Okay. But otherwise, they're all covered under Ind AS 102. So we got to be very, very careful, and we will talk about this in more detail, right? When we will cover the Ind AS 103 on business combination. So let's now talk about the recognition principle. So we talked about the scope, right, of what all is covered: a transaction with the employee, a transaction with the non-employee, and then it's a share equity settled share-based arrangement, or a cash settled, or it is a comes with an alternative. And then we picked up several examples in a way to help you understand the same. And then we also talked about what is scoped out, things like, a business combination is scoped out, something like which is to be paid where the stock price is now fixed, as to say that now whatever future variation, it doesn't matter the amount of benefit, then that is again not arrangement which is covered within the scope of this standard, right? So we've covered all of that in terms of the scoping. Okay. And now let's talk about how do you record this. End of the day, as I said, if it is equity settled share-based payment arrangement, right, then it's like a non-cash charge, right? You don't have to pay cash. Otherwise, with an employee, you have to pay salary, right? And in how you pay salary, by transfer of monetary assets, right, or like cash, right? But if it is a share-based payment arrangement, right, whether it's an employer or an employee, now depending upon the form of the arrangement, if it is equity settled, you don't transfer cash, right? You issue equity shares. So how do we deal with this, right? So from a timing perspective, from a cost recognition perspective, right? If it is in relation to the goods when received, if it is in relation to services when obtained, okay? Services when obtained, right? In terms of the recognition, the debit and the credit, right? Debit is an expense or debit to an asset, right? Depending upon, again, if it is related to Ind AS 2 or Ind AS 16 or Ind AS 38, then it is a, or it is a capital, right? If goods or service qualify as asset, and the credit of this in a way will go to what? Cash, if I have to pay cash, or I have to issue shares, right? It may go to equity, increase in equity for equity settled share-based payment liability, for cash settled, right? So it is a liability for cash settled and equity for equity settled, increase in equity box, right? To record as an asset if it links to Ind AS 2 or Ind AS 16 or 38, or otherwise it's an expense like a, like an employee compensation cost, or any, let's say, any third party services which I have received, like I talked about this advertisement services arrangement, right? And services when obtained or goods when received. That's the timing of recognition of the cost. Okay. So I'm going to deal with this again further with the help of an example. MNO Limited, right, purchases raw material from a vendor and agree to settle the same by issuing 50 equity shares. So essentially, what's happening here, right? You are purchasing raw material from a vendor and agree to settle the same by issuing 50 equity shares. Okay. So on the date, is the date of the contract, and then let's say after 2 weeks you will supply this. So whatever your price after 2 weeks is what you will issue 50 shares, right? So question is, what should be accounting treatment in the books of MNO Limited? So this is what, a share based equity settled or a cash settled, right? This is clearly equity settled because I am going to settle this by issuing equity shares. So this is an equity settled share based payment arrangement. Okay. So whenever I'm going to receive the material, then I'm going to record the fair value of the raw material, right? And then I'm going to credit my equity capital by that much amount. That's the accounting, right? However, if the, now this is important point, right? However, if the fair value of the goods or services is not measurable reliably, all right, the fair value of shares issued by MNO Limited can be considered. Okay, so there's an exchange. I'm receiving goods or services, right? And I'm issuing shares. So if you are doing a transaction with a non-employee, okay, if you are doing transaction with a non-employee, then you first try to determine the fair value of the goods or services as received, okay, and that becomes the basis of recording of the transaction. Now, if you are not able to determine the fair value of the goods or services received, then you determine the fair value of that transaction with reference to the value of the shares to be issued. Okay, only in a transaction with a non-employee. Now, this works the other way around. In the transaction with an employee, you determine the fair value of the services with reference to the fair value of the stock. Okay, and I'll try and help you understand this when, you know, with we'll try to summarize this as well. Okay, for you as we progress. Okay, as we progress, we have some examples there as well. Okay, so however, if the fair value of the goods or services is not measurable reliably, the fair value of shares issued by MNO Limited can be considered. Okay. Now, fair value of goods and services under equity settled share based payment arrangement. So you measure, this is what I was trying to say, an entity shall measure the goods or services received and corresponding increase in equity, measure the goods or services received and corresponding increase in equity directly at the fair value of the goods or services received, unless that fair value cannot be estimated reliably. Unless that fair value cannot be estimated. Fair value of what? That this fair value of goods or services, right? If the fair value of the goods or services cannot be estimated reliably, okay, then what do we do, right? Then if the entity, okay, let me just clear this for you. Yeah. So if the entity cannot determine, right, estimate the fair value of goods or services received, the entity shall measure their value and the corresponding increase in equity indirectly by reference to the fair value of the equity instruments granted. by reference to the fair value of the equity instruments granted. Otherwise, the preferable approach is that you first determine the fair value of the goods or services, and that becomes the transaction value. Now, if you cannot determine the fair value of goods or services, then you will determine it by reference to by determining the fair value of the equity shares. Okay. And that's how, equity shares or the option, as the case may be, depending upon which is the fair value of the equity instruments granted, right? And then that becomes the transaction value for appropriate accounting, right? The fair valuation is done on the date of the receipt of goods or services. It is done on the date of the receipt of goods or services, okay? On the date of the receipt of goods or services. Let's take an example here. A Limited has granted 100 share options each to 1,000 employees if they complete 4 years of services with the company, right? How will A Limited measure the cost to be recognized as per Ind AS 102 for the above transaction? Now, this is a transaction with an employee, okay? So, in the current case, A Limited has issued a share-based payment plan with service condition of 4 years. It's a transaction with employees. A Limited shall measure the fair value of the services received by reference to the fair value of the equity instruments granted. So for the employee, you will do it preferable approaches first with reference to fair value of the equity instruments granted. With a non-employee, the preferable approach is you first determine the fair value of the goods or services itself, right? Because see, the philosophy here is that it's very difficult, right, to determine what's the fair value of the service which you receive from an employee. Okay, because we see, right, when you look at any organization, one employee is paid 10,000 rupees, other employee, and there's another employee who's been paid possibly 10 crores also, right? I talked about Elon Musk in one of my example, right? And this guy has been paid hundreds of millions of dollars, right? And he's also an employee of the company. So, it's very difficult to put a value to what is the fair value of the services, right, rendered by an employee. And that is where the philosophy says that you will record this with reference to the fair value of the shares, which is more clearly evident, right? Whereas in the case of a transaction with a non-employee, it is assumed that the fair value of the goods or services is more clearly available. The reason because that non-employee is actually selling those goods or services to 15 other people, right? It's not only selling to you, they're selling it to 15 other people. And that's why that fair value is available, okay? And hence it is more preferable to use that as a transaction value. However, in some situation, if that's not available, then the alternative is to determine the fair value of your own shares and then determine the transaction value from that perspective. I hope the principle is now clear to you. It's very, very important for you. So in a way, if I were to just draw a small chart, right? So you have employee, right? And you have non-employee. Okay. Now here, your first preference is fair value of shares, right? Shares. Okay. Shares or share options, depending upon the type of the arrangement. Okay. And here, the first option is fair value of the goods or services so received. If that's not available, right? If this is not available, then you do the fair value of the services, which is very difficult to determine. And in this case, if this is not available, then you go to fair value of shares. So it works in a payment arrangement, okay, between the employer and the employee. Here you first use the fair value of the share option. There's a fair value of securities, and the non-employee fair value of goods and services so received, and then the fair value of shares if that's not available from that perspective. Okay, I hope this is clear to you. Let's take this example. Reliable Limited has entered into a consultancy agreement with a service provider and has agreed to issue 1,000 equity shares as payment. The services will be provided for 2 years. the value of the similar contract in the market is INR 50,000. How will Reliable Limited measure the cost to be recognized as per Ind AS 102 for above transaction? Now, this is a transaction with a non-employee. The fair value of the services is evident. So 50,000. So I'm going to debit expense and credit equity capital by what amount? 50,000 to be recorded over a 2-year period when services are obtained. And assuming if the services are obtained throughout the year, then you will record this over a 2-year period. Fair value of the services received should be used for measurement unless the fair value cannot be estimated reliably. In the given case, the fair value of similar contract will be used to measure the transaction. Okay. Now, fair value of goods and services under the cash settled share-based payment arrangement. Now, that in a way exposes the company to a lot of variability, right? Because if the share price keep going up and down, your cost in a way keep on going up and down from that perspective. Okay. So for cash settled share-based payment transactions, the entity shall measure the goods or services acquired and the liability incurred at the fair value of the liability, because the liability will keep on changing. Liability will keep on changing until the liability is settled, right? The fair value of the liability, until the liability is settled, the entity shall remeasure the fair value of the liability at the end of each reporting period, with the change in the liability again gets recorded as part of profit or loss account. Okay, as part of profit or loss account. Okay. Now we're going to talk about share-based payment award with a cash alternative. And remember, alternative is in whose control? Is in the control of the employer or in the control of the employee, or in the control of the issuer or in the control of the recipient, right? Or in the control of the grantor or in the control of the grantee. There are many terms, same things which are being in a way used to determine or to define a share-based payment arrangement between two counterparties, right? So let's look at this, a share-based payment award with a cash alternative. So entity shall account for that transaction or the component of that transaction, depend upon in whose control it is, right? As a cash settled share-based payment transaction, if and to the extent that the entity has incurred a liability. So if you will account for a share-based payment transaction with a cash alternative as a cash settled share-based payment transaction, to the extent you believe that you will end up settling this in cash or other asset. As an equity settled share-based payment transaction, if and to the extent that no such liability has been incurred, right? No such liability has been incurred. And there are two possibilities right here. One is it is in the control of the issuer, when it is in the control of the recipient, right? And that's where the concept of the compound instrument also come in, right? So accounting differs depending on whether the choice of settlement rests with the counterparty or the entity. So this is very, very important, right? For you to be clear here, right? So let's just absorb this, right? So what we're trying to say, that is, it is very, very important for you to be clear that the choice, right, of settlement what? Whether I'm going to receive shares or I'm going to get paid in cash, right, or other assets. Now that choice will determine that this choice is with whom. Is this choice with the entity or with the counterparty? That will determine the accounting. Okay. Now, if the counterparty, the recipient or the grantee or the employee or that non-employee, if the counterparty has the right to choose the method of settlement, treat the award as a compound instrument. In a way, ordinarily, we see this as that if the counterparty has a right to demand cash, then it is largely a cash settled, because you generally don't assume that you will be able to discharge your liability by issuing shares. If I have an option to demand cash, then I would like to settle this by receiving cash, right? From that perspective. So, but it is treated as a compound instrument, okay? And you got to split into a liability component, the counterparty right to demand settlement in cash, that's the liability, and an equity component, the counterparty right to demand settlement in shares. One split the entity account for the two components separately. Okay, so it depends, right? Now, if entity has the choice, if I have the choice of settlement, right, now then I will go by my intention. If I have the right to settle, then it is not a compounding, then I'll go by my intention. If I for the portion of the arrangement which I believe I'm going to settle by way of which I believe I'm going to settle by way of cash, that will be cash settled. For the portion I believe will be settled by way of equity, that will be treated as equity. So treat the whole award as cash settled and account award as a liability, or else account for the transaction as equity settled. So it all depends upon my intention. Okay, it depends upon my intention. So let's look at this example where the counterparty has a choice of settlement. So B Limited has granted share options to 500 employees, providing them an option to choose whether to receive cash or equity instrument, right? The option has a service condition of 3 years to be completed for option to vest. Okay, so the choice is here with the counterparty. Okay, option to choose whether to receive cash or equity instrument, right, for after 3 years. Okay, so then this, in a way, there is a transaction where there is the settlement as a cash alternative, and that is where I'll have to deal with this to say it's a compound instrument. Okay, in this case, B Limited has granted a compound instrument which include a debt component, which is the liability component, right, the cash which I may end up paying, and an equity component that I may end up issuing shares, right? So first, in any compound instrument valuation, you need to first determine the fair value of the entire arrangement, right? And then you determine the fair value of the liability, and then the delta, the differential, if any, then that goes to the equity box, right? From that perspective, the debt component, the liability needs to be remeasured, whereas the equity box, once goes in, it stays there. You don't need to change it. Okay, then the fair value of the liability, if let's say you said it's going to be cash settled, but let's say the employee decides to demand the shares, right? Now if the equity option is exercised, then what do you do with the liability which is sitting right in your balance sheet? So then that liability gets transferred on the date of settlement. That liability gets transferred to the equity box. I hope that that's kind of making sense to you, right? Then the fair value of the liability needs to be transferred to equity entirely, right? Now, B Limited has acquired a machinery from a supplier and has given an option to the supplier to either take cash or shares equivalent to the value of its share price, right? So essentially the same thing, right? In a way, I'm giving you, with a transaction with a cash alternative, and that's where I will have to, in which the fair value of the goods or services is measured directly. The entity shall measure the equity component of the compound financial instrument as the difference between the total fair value of the services, okay, or the goods, right, minus the fair value or the liability component, and delta goes to equity. Okay, so how do you measure that? Entity shall measure the equity component of the compound financial instrument as the difference between the fair value of the goods or services received and the fair value of the debt. So in all arrangement, you determine the total fair value. Okay, and remember, in case of a transaction with the employee, the fair value is determined with reference to the value of the share arrangement, right? Whereas in the transaction with a non-employee, the fair value is first determined with reference to the value of the goods or services. Okay, now once the total value has been determined, then I need to allocate between the debt component and the equity component, right? Or the liability component and the equity component. So first I need to allocate to the liability component, and if there is a residual which is left, that goes to the equity component. right? That is how you will do the accounting. So total fair value, and then let's say total fair value is 100, okay, and then the fair value of liability, okay, is say 90, and then what goes to equity is 10. 100 minus 90 is 10. That's how you do the allocation. All right, we'll do this with the help of an example. So entity has a choice of settlement. So CD Limited has granted share options to 500 of its employees. CD Limited has retained the option to either settle in cash or recognize by issue its equity shares. Okay. Now, based on the past experience of CD Limited, such options are usually settled in cash. Now, if that being the case, what will you do? You will treat that as a liability settled or a cash settled, and you will record the entire amount as a liability, as a cash settled share based payment transaction. Okay. Now, same thing, but now in your past experience of CD Limited, such options are usually settled in equity. Then you will treat that as a equity settled share based payment arrangement. In this case, CD Limited account for the transaction as an equity settled share based payment transaction. Now, there's a whole lot of difference, right, between a cash settled and an equity settled, right? The difference is in an equity settled, you don't need to do a subsequent true up accounting. Subsequent true up accounting for change in the fair value of the equity. Okay, in an equity settled share based arrangement, you don't need to do the true up for subsequent change in the fair value of the equity. That is why this is very important. Now, in a cash settled share based payment arrangement, you are required to do, required to, you are required, okay, you are required to true up, okay, you are required to true up. So you are required to, at every measurement date. That means your P&L is lot more volatile, your balance sheet is lot more volatile because your share price is keeps on changing, right? Share price, let's say you see, if you guys do a deal in stock market, right, the stock price change every day, right, whether it's a listed company. Similarly, for an unlisted company also, the perceived value keep on changing every day. Okay, so in a cash settled share based arrangement, you are required to true up your liability at every measurement date. Now, in an equity settled share based payment arrangement, you are not required to true up your liability after the date of initial accounting. Okay, which is on the date of grant, right? On the date of grant. Though in a transaction with a non-employee, the recognition itself occurs on the date when you receive the goods or services. Okay, and that is where the measurement date may shift, right? But you don't need to continuously, fair value it. So which exposes your P&L and balance sheet significantly. All right. So we will quickly summarize what all we've talked about. Equity settled results into an increase in equity. A choice of settle. There could be a choice of settlement, right? Or or if it is if there is a choice of settlement, right? Depend upon with the issuer or with the counterparty, the accounting is going to be different, right? Similarly, if it is a cash settle, that results into an increase in liability, and we talked about all different types of possibilities, right, between the employer and the employee in relation to the scope, in relation to the recognition, and what is being scoped out, right? So what's scoped out, in a way, the transaction which are in a business combination, right, they are scoped out, right? Or transactions which are then fixed or with reference to stock price and they do not change. If that been the case, they are also not part of the share based payment arrangement. All right, and now we will talk about lot more in terms of the vesting, the grant date, the exercise date, and a lot of stuff in a way, the core of the accounting, from that perspective. All right.